U.S. stocks fell on the last trading day of 2022, closing out the biggest yearly decline since the financial crisis of 2008. The Dow Jones Industrial Average fell 0.2%, the S&P 500 dropped by 1/4 point, and the Nasdaq dipped just over 0.1%. Jay Hatfield, the chief investment officer for ICAP ETF, said a sell-off in bonds was undercutting stocks as well.
The issue with the market, which has been true for 2 weeks, is since the ECB came out with their very hawkish policy, and the BOJ raised their target for the 10-year from 25 basis to 50. The global bond market's been selling off. And a lot of investors think, oh, that's bad for tech stocks, but it's unambiguously bad for really all assets.
10 of the 11 S&P sector indices dropped on Friday, led by real estate and utilities. Markets this year marked the end of an era of loose monetary policy amid aggressive interest rate hikes to curb inflation, fears of a recession, a seemingly unending conflict in Ukraine, and a staggering resurgence of COVID-19 in China. Not all sectors were hurt as badly. Energy recorded stellar annual gains of 58% due to a surge in oil prices. The focus now turns to the 2023 corporate earnings outlook, with growing concern about the likelihood of a recession. Hatfield, though, said he's less worried than some, believing that housing prices are currently lagging and that the broader consumer price index will soon reflect this.
CPI will cool off faster than people think, which will allow the Fed to pause, and we'll get through this cycle with either no recession or only a very technical recession. So we're way more bullish than most strategists about the market next year.
Still, signs of U.S. economic resilience have fueled worries that rates could stay higher for longer.